Hi friends, Simit here from InformedTrades.com. Today is our introductory video to value investing, one of the most popular styles of investing used by some of the most successful investors in the world, like Warren Buffett. In this video, we'll discuss some of the key principles of value investing, as well as how traders and investors can get started identifying value stocks. We have many other videos on this subject as well. You can check them out on Informed Trades. Let's get started. Okay, the key points we'll cover in this video. One, prices of financial assets are cyclical from the perspective of value investing or traditional value investing philosophy. As a result of this, the concept of mean reversion does apply. So if something is too high, it'll come back down. If something is too low, it'll go back up. Specifically, where the concept of mean reversion comes up is in looking at valuation ratios. If the value of something, a metric, a valuation ratio, is too low, we can buy it. If it's too high, to sell it. We'll get a little more into that in this video, and of course, we'll discuss specific valuation ratios in subsequent videos in the series. Earnings. Earnings is a big topic for value investors. Basically, a key part of the philosophy is buying stocks that have earnings potential. You're paying for future earnings. So if you can pay less for a company that's going to earn a lot in the future, that's sort of that's the kind of stock that value investors are typically looking for. And related to the mean reversion concept specifically, is that you can expect to hold assets for 3 to 5 years, if not longer. Warren Buffett, Charlie Munger, those are the most famous value investors, and they're known for holding investments for a decade, sometimes more. So as a concept, something can trade at a very high value for quite a long time, and that's when it's in the selling zone. You might be out of the market, you might be unloading positions during that time, and you can be accumulating for quite a while as well. It varies. That's not a hard and fast rule, but it is a good rule of thumb, and it's something you can expect if you're in value investing conversations with the majority of value investors. Okay, markets are cyclical, and this is sort of this chart you're seeing on the screen now, this visualization relates to sentiment, but it's closely related with valuation ratios as well. When future earnings when you have to pay a lot, when a stock's price is high relative to its future earnings or its future cash flows, that suggests the market is extremely optimistic. They think growth is just going to keep coming. That's when it's at the highest risk. And really you want to buy when the market is uninterested. When you want to buy when the prices of future earnings is relatively cheap, the market is not really valuing the company. The market is oversold. There's been panic. So a lot of value investors will want to buy after a panic, will buy after a crash, because that's when future earnings are at their cheapest. So buy low, sell high. That's sort of a simple, that's true for almost everyone. It's especially true for value investors. Some investors like growth or momentum investors, they may not place as much credence or as much weight on the idea of buying low and selling high and buying after a crash. But value investing, definitely that's sort of what it's about. And value investing has typically worked very well. You know, the most successful investor, Warren Buffett, he's a value investor at his core. Mean reversion. Okay, so what you're seeing on the screen now is profits of U.S. and European publicly traded companies. Europe is this brown line here. U.S. is this blue line, navy blue line. And you can see that it sort of goes in a wave-like pattern, right? Once it gets too high, that's when it's going to come back down. And when it's too low, that's when it's going to go back up. So that's sort of the idea here, and you can see it. You know, this wave-like pattern is also related to the market sentiment concept. Here's the wave-like pattern that we saw. So the two concepts are a bit related. This is what you're seeing now is the idea of profits. Now we sort of get into how we can quantify this. And that's where valuation ratios come in. Basically, you want to look at a time where, you know, the price relative to the profits is very low. That's the time to buy. And conversely, if you have to pay a lot for profits, then that's a time to sell. And invest in future earnings. Here, this chart here is basically the same idea as what we looked at here. This one is just showing the price-earnings ratio, which is one of the key valuation metrics, one of the most common ones, and we'll talk about it. We'll have a whole video dedicated just to the price-earnings ratio. But basically what this ratio is about is the price of a stock relative or divided by its earnings. So you could sort of a way of quantifying how much do I have to pay for the earnings, the profit of this company. And when that number is too low, when it goes to around 10 or lower, that's a good buying sign. When it goes above that, you may be interested in selling. As you can see, it's not a perfect indicator. And in bubble markets, you may end up selling too early. In times of extreme crashes, you may end up buying too early. But generally it works, and you can combine it with other indicators to refine your analysis even more. This is the S&P 500 right here. You can see the concept of mean reversion is playing out a bit, and this chart goes back to 1968. So you can see, the P/E ratio doesn't really go above 25, only did that once. It really, if 20 is a point where, you'd probably be a little nervous. And of course, if it's around 10, well, it doesn't go that far low either. So this sort of P/E ratio is just one valuation ratio. It's something to consider. And that's basically, you sort of can get the idea now that one of the most common value investing strategies is to screen for stocks based on valuation ratios. So based on, show me stocks that have a low price relative to their earnings, relative to their cash flow, or conversely, they're generating a lot of profits based on how much equity they have, based on their assets, based on how much investments they have in the market in terms of in their operations. Price to book is about the company's share price relative to the book value of its assets, and net working capital, similar concept there. So these are some valuation ratios, and we have for the rest of this video series, we will be doing one video on each of these metrics, whether or not it works, looking at some back tests, what exactly it means. But basically, you want to, if you're a value investor, you want to combine these metrics, and you want to look at a screener. The screener I use is GuruFocus.com. This is a premium screener, and we'll compare the pros and cons of a free screener versus a premium screener. There's a bunch of free screeners. Google Finance has one, Yahoo Finance, Finviz.com, UncleStock.com. There's a bunch of free screeners out there. What you can do with the screener is, and I'm on the valuation rank tab, so GuruFocus.com. You can screen on a bunch of metrics. You'll see there's valuation ratio here. We'll get to that in a second. Valuation rank, and show me stocks that have the lowest 10% based on their price earnings ratio. Right. So a couple slides back, we saw that stocks with a low price and earnings ratio often revert. So let's see who's at the lowest in the market now. And here's some numbers you can see, 10, 12, some down here. And this might be a starting point as to our investing. We can also, we can clear this and look at valuation ratio, and we can enter in some specific numbers. Show me price earnings ratio no greater than 15, for instance. Show me price book ratio no greater than 5, for instance. And we can add some other characteristics. For instance, smaller companies tend to be more risky. So, higher risk, higher reward. So let's say we only want to invest in companies with a market cap of at least 10 billion, that are trading at low valuation ratios. And here we already have 512 companies, so we can filter by even more. We can filter by quite a bit and get to some stocks that we think are interesting. We can focus on industries and things like that. So that's sort of the idea of how you use a screener. There's a lot to it, but understanding these valuation ratios, these metrics, is sort of at the heart, and applying them with a screener sort of gets you that list, sort of is the starting place of how you can find stocks that might be undervalued, might be worth your time and money. One other point, and we'll have a video on this as well, buy low, sell high. That's, of course, an important part of value investing and sort of an important part of any type of investing or trading. But the other part is have patience. We talked about how value investors tend to hold for 3 to 5 years, if not longer. And part of the reason for that is because, it's just not an active philosophy, generally speaking. This chart here illustrates, that the majority of the great moves happen on a few days, right? So over a period of 20 years, if you missed the 10 best days, you're going to be 3% lower, pretty much. 4% lower. 4%, almost half. Half the returns came on 10 of the best days. So if you were just out of the market, if you were in the market for 5,033 days, but those 10 days that you missed were the 10 best performing days, you missed out on half the earnings. And that's part of why value investing has a buy and hold philosophy. When something is undervalued, buy it then, and then hold on to it until it's overvalued. This may take time. It may take a couple years. But the idea is you might not know specifically when that big move is going to come, so you want to be in the market when it does. That's sort of an overview of value investing. Basically understand those ratios, apply them to a screener, and that's sort of your starting point. Buy low, sell high. Any questions you have, anything you want to add, join us at informedtrades.com. And of course, we'll have a lot more videos in this series that go in detail into the topics presented in this video. Best of luck in your trading and investing, and we'll see you next time. Take care.